Welcome, everybody. SF Live, episode number 39. I'm joined by Phil Baker. He's the president and CEO of Hecla Mining. And as always, before we get started and switch over to Phil, just a quick reminder, please use hashtag AskHL for their company ticker. They're listed on the New York Stock Exchange under the ticker HL. And we'll get to the questions at the end of my conversation with Phil. Also, follow us on YouTube and Twitter. That way, you can see when we come live with more content. Let me switch over to Phil now. And I'm quite excited to have you come on the show. And I've tried to find content on the internet and try to see if you've done any other interviews besides the Kitco one at BMO. And I'm quite excited that this is almost a world exclusive. So welcome, Phil. Great to have you. Yeah, how are you doing? It looks like you're in the office in Coeur d'Alene. So give us an update on how things are going at Hecla right now and how you've been handling the whole pandemic situation.
We implemented our pandemic plans first by stopping people's travel, and you would be familiar with the PDAC. We canceled our participation in that because of the concern over the virus. We had stopped travel at that point, and we implemented our pandemic plans at each of our mine sites on the 10th of March. So we've been ahead of the curve. We've been fortunate that everywhere but Quebec and Mexico, we have been able to fully operate. We've had no shutdown, no reduction in production. And in Quebec, it's the effect of it is about a month and a half reduction in production. And then, of course, Mexico is our smallest operation, so it really has had very little impact on us. So we've been very fortunate, and while there's some increase in costs, it's pretty minimal relative to what we've seen happen with revenues.
Interesting. Okay, and Quebec, Casa Berardi is making about 40%, I think, of your revenue, is a big part of your revenue. And I'm quite curious, like the 6 week shutdown, like how has it, like you
well, no,
it's
not a 6 week. It's not a 6 week shutdown. It's the effect is about 6 weeks worth of production. Shutdown was 3 weeks, and then you have the ramp up. Ramp up takes about a month to get to full production. We're just about there now.
Fantastic. Okay. And you started on May 14th, if I'm not mistaken, with the ramp up. So that's, I think, when Quebec allowed mining operations to go back
that's right.
operation.
That's right. Yeah.
So,
so we were really only shut down for 3 weeks.
Okay. Now, I'm quite
and
curious.
then you said I'm in the office. We're in the office because we're an essential business in Idaho, and so we've never had to shut down any of our offices.
That's important. Like, how did Quebec handle the situation from a government perspective? I'm quite curious. You're running a fairly big operation out there. It's not cheap to shut down or slow down production at a mine. It's not like you flick off a switch and just throw the keys in the mailbox and leave, right? So there's more involved. Was there any government support? Like, are they helping you maybe financially or something?
Look, the government, had a big problem to access. It took them a little bit of time to realize what businesses could operate safely. The mining industry is set up, and we work every day to have people safe. And so once they realized that, we gave them, as through the Quebec Mining Association, all of our plans. And once they realized that we could operate safely, they allowed us to go back to work. And then as far as financial support, there's been a small amount related to the layoff of workers or the reduction in our revenues for that 3 week period of time. And so we've gotten a few $1 million, but it's, the main thing has been able to go back to work.
No, I think that's important for the communities as well. And I just see with my kids as well, it's also a huge social aspect, right? Just meeting with your colleagues again. Let's talk about the first quarter. And like March, you already saw a bit of a slowdown in the first quarter overall. Do you want to run us through a little more detail on what the first quarter looked like?
The first quarter was pretty much what we expected. At the end of the quarter, we had the slowdown in Quebec. So we lost a little bit of revenue there. We lost a little bit of revenue from the timing of a shipment in Alaska, but otherwise it was very much as expected.
Yeah.
We one of the things we did was when we realized that this pandemic was going to be pretty extensive and we didn't know what the governments might do, is we drew down on our revolving credit facility, put a couple $100 million of additional cash on the balance sheet, and just put ourselves in a position to be able to weather whatever might come.
That revolver drawdown really dramatically increased your cash position. And I'm curious, you drew down a whole 210 million at one time. And my question is, like, why not maybe go in $50 million increments? Because probably triggers interest payments immediately as well. So I'm just curious.
Sure. Because when you draw down under a revolving credit facility, you have to make certain representations. And if the government had shut you down, you might not be able to make the representations. So you might not have that money available to you.
Okay.
So you draw it down first, you see what the governments are going to do. You make sure that you can work through whatever it is that comes. And then if you find that you don't need it, you just repay it.
Oh, okay. So there's no penalties to repaying it early or anything like.
Well,
like
there's some, but it's pretty inconsequential.
Oh, okay. Good point, actually. Like, you could repay it. Is that the number one priority, or do you actually plan to use the funds for maybe an acquisition or some other maybe capex related to one?
No, it was merely to fortify the balance sheet. Remember, that debt's not due until 2003. I would anticipate that there'll be very little drawn on it over the course of the next couple of years. But if we do draw, then we would repay it in 2003, and then our main debt is due in 2028. So we have a long way to go.
Yeah, and that's the the credit note you just refinanced earlier this year, right? Do you want to run us through the details there?
Yeah, well, that was part of the assessment that we made early in the year when we saw the border shut down with China. We said we need to get this refinancing done quickly. So we advanced our earnings release, and we went in the first week of February, second week of February, and got that behind us. Very favorable interest rate, 7.25%, 2028 maturity. You know, basically our interest cost now is the same as it was before. You know, if we had waited 2-3 weeks, who knows what the availability would have been? Who knows what sort of rate we would have had to pay?
No. You mentioned the rate. I think I saw it slightly went up to the previous note. Is that just because you had to pull the trigger so fast?
Just the change in the interest rate environment. That's all it was.
Oh, okay. So interesting. No, let's run through the projects just a little bit. I'm really curious about Nevada because I've followed Klondike Gold, and it was when they got bought out in 2018 by you, so I'm still have an eye on it. And I've actually been to Fire Creek myself a few years ago, so I have a personal interest in the asset. So can you run us through the Nevada as well, and what you're planning to do there?
So Nevada is an operation where we got not just Fire Creek, but we also got Midas, we also got Hollister, and the Aurora property. And so we're going through and we're assessing what it is we can do with each of those properties. I mean, it's a huge land position in the heart of Nevada. We're looking for high grade deposits. These are different than what Barrick, Newmont, other large producers in Nevada are looking for. And we think there's the opportunity for 1 ounce sort of deposits there. Fire Creek has had a history of that. Midas has had a history. Hollister has had a history. So all three of those properties. So we're in the mode of making an assessment of what we can do there. Now, we just recently announced that refractory ore we can ship to Nevada gold mines. That really opens up a lot of possibilities for us. We'll do a bulk sample with them, and we'll see what the results of that will be. And then next year, we would anticipate making a final decision on further development of Fire Creek.
Interesting. Okay, the Fire Creek, I love it because it was very narrow vein, but ultra high grade. It's like I don't think I've seen that somewhere else in any of the mines I've visited so far. So that was quite exciting to see.
Absolutely, you know, and you think about a company like Kirkland Lake, that they go into a old district in Australia, and they find this very, very high grade mineralization. That's the sort of potential and the impact that's had on that company. That's the sort of potential we think this land package has for Hecla for us to find this 1 ounce sort of material and quite large. And we have a number of targets, both at Fire Creek and at Hollister, what's called the Hatter Graben, and within Midas. So all 3 places, it's pretty unique set of assets. So that's why we acquired it.
And you stopped development of the stopes or of the mines itself. You're just mining ore or stockpiled ore right now. How much longer is that going to run, and what are sort of the plans? Like, can you give us some more details on the timelines that you're pursuing there right now?
Yeah, we'll operate mining the existing stopes through into the third quarter. And then we'll have to rely on the bulk sample after that, and then we'll have to make a determination as to whether we continue to mine or we do further development, further exploration.
Okay, so no set timeline yet or anything in that regard.
Yeah, no. Now the good news is we have determined that we did a hydrology study. We determined that the water will be very manageable and will not require the permitting that we were afraid we might require. So that part's behind us. The next step is in doing the bulk sample is we'll be able to test whether we can mine at a more productive rate. And if we can do that, we can lower the cutoff grade, and then you have even more mineralization that's available to you.
No. Okay. No, interesting. Now, I'm quite curious to see your developments down there in Nevada and how things are progressing. So from a personal level as well, as I said.
Look, it's just a fantastic place, right? The best place in the world to mine is in Nevada.
Yeah.
And we're right in the heart of it.
Sure. No, Nevada is one of my favorite states personally. So yes, I can agree with that. Just a couple things I wanted to talk about on the financial side again, real quick. You put a gold price collar in place, if I'm not mistaken, for Q2 and Q3. Is that correct?
No collar. We only have bought puts.
Oh, okay. Because I saw a range of 1450 to 1650 for the gold price, so I wasn't sure what that exactly referred to. So I was wondering if you were hedging like that.
The disclosure is for each quarter we have a certain price that we have been able to buy puts. Mm-hmm. And so what we've done is we've protected ourselves if there should be a downdraft in the price of gold and silver, like we saw in 2008. And the same thing for the lead and zinc. So, we've experienced that downdraft. We're not anticipating that happens, but should it happen, we're going to make sure we maintain our liquidity.
Okay. We've also been getting a couple questions in, and one of them is referring to the balance sheet, and it's about the long-term, he called it the long-term bad habits. One of the investors sent it in via email, and I'm just going to read it out. And your company has been criticized over the years for 2 long-term bad habits. 1, badly timed acquisitions and maybe overpaying for assets, and 2, overuse of the debt market. And the debt load is quite heavy. I think you have interest payments of $16 million per quarter right now. The leverage to silver and gold, is that, how are you going to get the metals? The metals are getting more fashionable, but how are you going to address the long-term financial issues at the company? Like, what's the plan to sort of turn the ship around balance sheet and financially?
Well, the amount of leverage we have is appropriate for the quality of the assets that we have and the life of those assets. Realize these are assets that will operate for decades to come. So we're not in a situation where we have this debt load that is going to not be able to be covered by the underlying assets that we have. So that's the number one thing to realize. Number 2, when you look at the coverage ratio that we have of the interest and of the debt, very capable of covering that. We would anticipate seeing our debt to EBITDA ratio, which is the key ratio that people look at, be order of magnitude 2 times. That's what it's been historically. That's very, very manageable level of indebtedness, particularly the sort of indebtedness that we have, which is so long term. You think about debt that's due in 8 years. It puts you in a different category from companies that have debt that's a revolving credit facility, for example, that's due a year, 2 years, 3 years. That revolving credit that we use is really just to provide liquidity. It's not a long-term underlying leverage that we put on the balance sheet. In terms of buying assets, look, we've bought assets that we think have shown great value. Number one, Greens Creek. That's an asset that has generated anywhere order of magnitude $100 million of free cash flow a year consistently for the last 12 years that we've owned it, and we have another 20 years in front of us that we would anticipate it will do that. Casa Berardi has been an asset that has not generated a lot of free cash flow, but it hasn't required any investment by us, and it continues to grow its reserve base. We continue to see that it's creating value. Now, we could have operated it to have it be more cash flow generative, but it would have had a shorter mine life, and we now have another 15, 20 years in front of us there. And then with the Nevada assets, look, the jury is out, and much like Greens Creek, where we had a period of time, if you go back 30 years ago, that mine was shut down. But look at what it's done since. It's generated over $2 billion of free cash flow. We think that's what Nevada will do. So you need to look at these assets in the long term for what they have done and what they can do.
Okay, no, perfect. I think that's a good answer to that. So, one thing I wanted to ask you is, like, I noticed in your presentation, you're using fairly conservative, or not just in the presentation, but internally, you're using fairly conservative price assumptions for gold and silver. And I'm curious because, in reference to another slide in your presentation, you mentioned how you've been able to increase reserves at the mines. So I'm curious, like, if you were to translate that into more, let's call it modern day prices, let's see where we end up after today. We've been touching 1700 this morning, right? But let's say if you transfer that into modern day pricing, let's say 1650 to be a little more conservative, right? But what would the mine plans look like? And just give us an update maybe on that and some blue sky there as well.
Well, we don't make reserve scenarios that have those high of prices, frankly. What we want to do is expand the margin, generate more free cash flow. So we're not going to just mine at with ounces that just break even. We want margin. So the short answer is that doesn't really matter. The prices that we use are not they're prices that we have seen in the last 2 to 3 years. So they're quite relevant prices.
Yeah. So in the next quarter or the MD&A, you're not going to update that to 1450 or 1500. No. I know it's like a lot of companies do that for peacocking purposes, right? So, no need. Let's talk about exploration and reserves and resource calculations and all that. Like, what are you doing to advance the assets? Let's talk about more OPEX development and stuff like that as well. Like, what are next steps maybe at some of the mines that you're taking?
Well, look, each of the mines have their own program. The two that so something's happening at all of them, but the two that I'll focus on is Casa Berardi and the Lucky Friday. Casa Berardi, what we see is the opportunity to improve the reliability of the mill there, improve the throughput, and improve the recoveries. And we think those three things are going to cause us to reduce the cost of operating about $100 to $200 per ounce. So we're going to have a double benefit. We're going to reduce the cost, we're going to increase that margin, and we're seeing higher prices over our reserve assumption. So our margins we think are going to widen out to $500 to $700 an ounce. So that's Casa Berardi. At the Lucky Friday, that mine is in a ramp up. It's been, operating at about 10% of capacity. We'll be at 100% of capacity by the end of the year. So you'll see production there increase tenfold. And then you'll see next year and over the next 5 years, because grade increases, you'll see production go from 3 million ounces a year of silver to 5 million ounces. Costs will come down as a result of that on a per ounce basis. And you'll see margins increase probably to the same sort of levels that we see at Greens Creek. So this will be a mine that'll be a $50 to $100 million of free cash flow at current prices for the next 30 years.
Fantastic. Phil, we're slowly hitting our time limit. So I want to give you an opportunity to talk about more upcoming catalysts for the company as well. And to maybe some next like news release, like it's always interesting to talk to a producer because it's completely different than talking to the junior exploration company. So I could talk to you for hours, to be quite honest. There's so much interesting stuff we could talk about. But give us an update, like a bit of a forecast in terms of news flow and kind of catalysts the company's about to hit.
Well, look, the real catalysts are what's happening at Casa and the Lucky Friday. But in addition to that, you have the work that we're doing in Nevada, where if we are able to confirm that this bulk sample works, then you're going to have an extension of that mine, and you're going to have that thing operate for another 5 to 10 years with the current resource that's been identified. And then the same thing happens in Mexico. We're doing a test of the sulfide mineralization there. If that becomes successful, and we'll make a determination of that next year, then you could see that operation extend for another 5 to 7 years. So you've got, at all 5 of our operations, you've got incremental improvement at Greens Creek, and then you have at each of those other operations significant improvements. The mill at Casa, the expansion at the Lucky Friday with its restart, and then the potential for both Nevada and the San Sebastian operation to go into a long-term production cycle.
Oh, fantastic. Phil, thank you so much for the update. Thanks for joining us today. Thanks for joining SF Live, and thanks for being available. This was really informative, and good luck moving forward, and good luck with the ramp up of both Lucky Friday and Casa Berardi. So, and everybody else, thanks for your questions. Thanks for tuning in. This was SF Live, episode number 39. Thank you so much.